Hello and a very warm welcome to this week's Policy Watch, our weekly program that keeps you abreast of all the major economic developments during the week. Our three top stories this week are the Big Bang reform announced in FDI, foreign direct investment, the rescue efforts mounted by the Reserve Bank of India in the forex market, and the government's decision to issue an ordinance to empower capital markets regulator SEBI. And joining me in these discussions is a very special guest, Dr. Subir Gokaran, Head of Research at Brookings India and former Deputy Governor of the Reserve Bank of India. Welcome to the program, Subir.
Thank you, Mythili. Thank you.
Well, our first two stories are more or less linked, but acting on the recommendation of a committee headed by Arvind Mayaram, Secretary, Department of Economic Affairs, the government has hiked the ceiling on foreign direct investment, FDI, in a host of sectors, including telecom, single brand retail, and oil and gas. Better still, the need for prior approval of the FIPB, which is a Foreign Investment Promotion Board, has been done away with in a number of sectors, provided the FDI is within a specified ceiling. The move comes in response to the problems posed by a growing current account deficit that is putting pressure on the rupee and raising the spectre of a serious crisis on the external front. It also comes less than a year after the government allowed FDI in multi-brand retail trade and raised the cap in FDI in civil aviation to 49%. What does this mean for the country? How much more money can we hope to get? We'll discuss all this and more with Subir. But before we do that, let's hear this Bureau report.
Commerce Minister Anand Sharma announced the government's decision to further liberalize the rules for bringing foreign investment in at least a dozen sectors. Most anticipated among these was the decision to allow 100% FDI with a caveat that investments beyond 49% would require the approval of the Foreign Investment Promotion Board under the Finance Ministry.
There is a raise of cap from 74 to 100% in basic and cellular services. Up to 49% it remains under automatic route, 49 to 100% through the FIPB approval route.
100% FDI in courier services is now allowed through automatic route. The government removed the need to obtain FIPB approval for petroleum and gas refining, commodity exchanges, power exchanges, stock exchanges and depositories while retaining the 49% limit. 100% FDI is allowed in asset reconstruction companies, but foreign investment above 49% would require an FIPB nod. Credit information companies can have up to 74% FDI through automatic route. In a major relaxation to the retail sector, the government has done away with the requirement of FIPB approval for investing up to 49% in single brand retail chains. In order to leverage India's huge defense imports to earn foreign money, the government inserted a special provision to allow up to 100% FDI in defense production for acquiring modern technology.
The only difference being that here the CCS will take the call. Only those proposals will be sent to the CCS for FDI in defense above 26%, where state-of-the-art technology is involved in defense manufacturing.
India is the world's largest arms importer and its armed forces buy military equipment worth billions of dollars every year. The country is also about to finalize some big-ticket defense purchases, including a $20 billion deal to acquire 126 fighter jets from France. Though India has an elaborate offset policy, but a sectoral cap of 26% is considered an impediment in bringing in foreign capital in the sector.
Subir, after almost 4 years of inaction on the policy front, the government suddenly seems to have gotten to overdrive. September last year, we saw the FDI in retail, and now suddenly there's been a host of FDI hikes. What really explains the need? Why is there a sudden desperation, quote unquote, to get more foreign direct investment?
Well, I think we have to look at it from two perspectives. One is the merits of opening up these previously limited or restricted sectors to FDI. Let's not put it in the specific context of what's happening today.
Okay.
And the second is then why today, as you're saying, why not a year ago, 2 years ago, 3 years ago?
Yeah, it could have had some impact.
When it could have had, perhaps even more. If you think it's going to be positive today, it should have been positive 3 years ago as well. I think from the first perspective, which is the merits of FDI, increasing FDI flows into certain sectors, there are two very clear motivations. I think both of them have come through in the statement that the minister just made. One is that these are sectors that are facing resource constraints in their efforts to expand. So if they're being done by Indian companies with FDI limits, resources are becoming a little scarce, and so the possibility of expansion is starting to fade out. And I think telecom is one example where essentially coverage is now plentiful, but technology is growing, quality is obviously suffering, so some investment needs to be made in terms of keeping the network, making the network more efficient. All of these factors require more resources. There is more technology out there which perhaps can come into play here. On the defense side, as was also said, that at this point, trying to reinvent the wheel on every product is proving to be extremely not only is it proving to be inefficient from a cost perspective, but it's also risking security because you just don't know when the delivery will take place, if at all. So bringing foreign technology in, again, tried and tested, perhaps at least tested somewhere, you're jumping up the sort of the life cycle of the product, and to the extent that it's bringing technology into the country, it has that positive. So these are merits independent of the current macro situation. Okay. These are arguments in favor of opening up on these sectors
at any
regardless,
point of time.
At any point. And that, I think, points then to or raises the question as to why these decisions were not taken in other circumstances. Well, that's where I think the pressure of circumstance, the force of circumstance, as it's called, famous short story, becomes important. These are measures that were obviously resisted by various stakeholders at various points, and there wasn't any external compulsion for the government to act. Now you have that. Now you have a situation where a balance of payments stress, I wouldn't use the word crisis, but I certainly use the word stress, is very vivid. Everybody sees it. There is no need to or no room to question or quibble about whether we are in a very severe stress situation. So that then starts to weaken the resistance, because the government has the argument, hey, look, if we don't do it now, there are consequences awaiting. We don't know how things are going to play out. So that, I think, creates an opportunity. So the opportunity is created by the current stress on the rupee, on the overall balance of payments, and that opportunity was used. That opportunity was not so vivid, not so visible 3 or 4 years ago. I think that then raises the second question. Because of the circumstances, are these measures going to have an impact?
And that is the irony, because actually the external sector problems require a quick solution, whereas FDI, you cannot really expect to see quick inflows.
I think you're absolutely right. I think it's like in any household situation or corporate situation, and you can't use channels which take time, which involve strategic thinking and strategic decision making to solve your liquidity problem. FDI decisions are strategic. You're not going to get the money in overnight, because people are now going to evaluate the opportunity, look at the prospects, say, hey, look, is this a good business environment to put our money in? And to a large extent, we keep making this distinction between foreign investors and domestic investors as though they're from separate planets. They're not.
Which is not true.
They fundamentally react to the same incentives.
And we've seen from the doing business.
If we are not able to persuade domestic investors to invest, and that's what everybody is complaining about, I don't see how we're going to persuade foreign investors to invest. So I think the challenge here and the larger compulsion is, how do we get the investment climate back on track? How do we make it more attractive for everybody to invest? In that scenario, FDI being more open, restrictions being lifted, makes a lot of difference in terms of people's ability to come in. And I think that's the perspective which has to be kept in mind, which is, if you use FDI as an instrument, you're taking a strategic perspective, not a tactical, not an operational perspective.
Because ironically, on the very day that the government announced this, we saw 2 foreign investors actually announcing their decision to pull out. So I think on that note, we will have to take a break, but please do stay with us. We'll be back very, very soon. Welcome back. In a bid to restore stability to the foreign exchange market, the Reserve Bank in India announced a number of measures just the day before the government announced its Big Bang reform in FDI. The measures, which were aimed at tightening liquidity in order to quell speculation against the rupee, however, had mixed results. While the rupee recovered marginally the next day, the stock markets fell even lower as bond yields rose sharply. The RBI moves are often very difficult to comprehend for the lay public, who are more concerned about what the rising rupee means for their monthly budgets. Luckily for us, we have Subir to demystify what the RBI's actions mean. But before we do that, let's hear this bureau report.
The Reserve Bank of India's attempt to remove 12,500 crores from the system through a bond issue failed, with the central bank managing to collect only 2,500 crore. The bond issue was part of several measures initiated by the RBI to curb volatility in the currency market and to arrest rupee's decline against the dollar. RBI hiked medium-term bank lending rates from 8.25 to 10.25% to tighten liquidity. The Reserve Bank governor told an international audience that the bank allows the exchange rate to be determined by the market. However, it intervenes in the market to curb excess volatility and to remove threats to macroeconomic stability. The rupee was at 53 or 54 levels against the dollar in April. However, it touched a historic low of 61 against the greenback early this month.
Subir, you've been there, done that. Can you just explain to our viewers what was the rationale behind the RBI acting as it did? Why is foreign exchange volatility so bad for the market?
Well, I think let's first look at it from the perspective of what is causing this massive movement in the rupee. There is a strong global element to it, and this element, this force has actually affected many currencies. Now, when you look at countries across the world and look at the extent to which their currencies have moved, there are two very distinct groups. One group constitute countries whose current accounts are essentially in surplus or very narrow deficits.
Like China.
And China is a huge on one extreme. But there are many countries in Asia which have small surpluses or are about in balance. Sure. Their currencies have moved, but not to a very significant extent, relatively speaking. But countries which have traditionally, conventionally have run large current account deficits, and India is certainly amongst them, but there's Brazil, there's South Africa, there's Turkey, there's Mexico. All of these have seen their currencies move to a far greater extent. So let's keep this global factor in mind. Okay. To that extent, the movement of the rupee is not entirely attributable to factors that are domestic. Okay. But then we look at what's causing the current account to be so big and why are we leaving ourselves so vulnerable to this. I think there's a long story there, but let me put it into three very brief sort of categories. Oil is a problem. We're importing a lot of oil. We're not pricing it correctly. Now, we may get some benefit through conservation if we price oil correctly. That's one story. Two, we're importing a lot of gold. This is very well known. Our gold imports have almost tripled as a share of GDP over the last 5-6 years. And that reflects many things in terms of investor preferences and so on. But we have to find a way to deal with this. And third is that our mineral balance has completely shifted. We used to be very large exporters of iron ore. We're not doing that anymore because of mining restrictions. We used to be basically self-sufficient in non-coking coal, and now we're very large importers of non-coking coal. It's ironic that we are amongst the largest reserves of iron ore and coal in the world, and yet we're not able to utilize this to give our balance of payments, some stability. And I think that's a major policy focus that the government has to sort of put priority on. So those are the three elements which have taken us to the situation. When you're in that situation of vulnerability, even a small shock tends to have a very large magnified impact, and that's what we're seeing in the rupee. Now, the rupee is moving very sharply. Anybody who has an exposure to the rupee is going to be hit. Simple example, people who have their kids studying abroad suddenly find it 20%, 25% compared to a year ago more expensive. People who want to travel find it correspondingly more expensive. People whose companies who are importing inputs to produce their products, now suddenly they have a cost shock. And very importantly, companies who borrowed abroad and have costed their projects based on a certain exchange rate now find that those projects aren't viable because their repayment costs have gone up so sharply in rupee terms. So all of these are stakeholders who are hit by rupee depreciation. Of course, there's a reverse impact when it appreciates, but that's not so hurtful, I think, generally speaking. So what we have is the possibility that all of these impacts actually start to affect the way people spend, the way people invest, the way people plan for the future. and that then possibly spills over into growth and other macroeconomic outcomes. So I think that's where the need to try and keep it within some sort of boundaries is concerned. Now, what?
But even the man on the street also gets affected because higher prices, things like oil, etc., affect even the man on the street.
Absolutely. So anything that has an import content, unless the government absorbs the shock or the impact, it translates directly into people's daily sort of expenditure patterns or the prices of the things they consume. Yes.
So what should the focus be? Should we try and reduce our current account deficit somehow by pricing oil at market prices, or should we worry more about financing it, which is a bigger urgency?
Well, I think let's look at it in terms of an analogy of a person having an accident.
Okay.
When you take a person to the hospital, there's a hierarchy of treatment. If he's badly injured, the first level is emergency room.
Okay.
And there the only objective is to keep the person alive. It is, I don't care how much damage I'm doing to his appearance, I may have to break a few bones to do that, but I'm going to keep him alive. Why? Because my priority is to make sure that he is in a position to receive the next round of treatment, which is when the actual healing or the sort of the curative part comes in, and then there's perhaps a cosmetic part at the end, which is let's restore him to his old appearance. Now, what we're seeing here is an initial response in terms of the crisis management, the emergency room treatment. The correction in the current account deficit, which is absolutely critical, is the second phase, which is that needs to be done. You're not going to save the patient if you don't do it, but for the moment you've actually got to keep him alive while you're doing the other things. And I think that's where we are at this point. The Reserve Bank measures that were announced on Monday are essentially reflective of that. Now, what do they mean? How are they expected to work? Well, it's very simple again. The rupee to the dollar or number of rupees to dollars is the price of dollars. There are two ways to look at a price. You make one or the other more expensive or cheaper. So if the rupee is falling, it means it is getting cheaper vis-a-vis the dollar. The direct way to deal with it is to make the rupee scarcer. To in fact reduce the supply of rupees. What the measures that were taken on Monday do is essentially make the rupee scarcer. Sucking out liquidity from the system is exactly equivalent to making the rupee scarcer, and therefore you hope that it's going to be more expensive.
Except that there's always a flip side. So you make the rupee scarcer, interest rate goes up, and then corporates cry.
So this is in relation to the dollar. The other side of the equation, which is where the risk comes in, and I think it's important that we keep in mind the risk, is that it becomes scarcer for everybody, not just the people who are buying dollars. So you make it scarcer for people who are buying dollars. At the same time, you're making it scarcer for everybody who needs rupees, borrowers across the board, consumers who borrow, companies borrow. So obviously, the rupee becomes scarcer, interest rates get pushed up, and that's being reflected in the market as well.
So I'll have to interrupt over there, Subir, because we have to go into a very short break. But please do stay with us. We'll be back very soon. Welcome back. It's a season for ordinances, or so it would seem. With less than a month to go for the monsoon session of Parliament and less than a fortnight after the government decided to issue the ordinance on food security, the Cabinet has cleared an ordinance to give the capital markets regulator, SEBI, more powers, including the power to authorize search and seizure. So far, SEBI has been seeking more powers for a while, and while many would agree, especially after the Sharda chit fund scam, that SEBI does need more powers, we need to know, is an ordinance really the best way to go about laws that actually need to be debated in Parliament? Do regulators really need more powers, or is it a question of exercising the existing powers better? We'll get Subir in on that, but first let's hear this report.
In order to prevent Sharada chit fund kind of scams, the government promulgated an ordinance to give more powers to securities market regulator SEBI. This ordinance got the President's nod on Thursday. In an official statement, the government admitted that there was a gap in the legal and regulatory framework allowing unscrupulous Ponzi scheme operators to dupe investors. The government also said that these amendments would give SEBI power to clamp down on such entities. Tens of thousands of small investors lost their lifetime savings when the Kolkata-based Sharada sank. The scam highlighted the need to strengthen the regulatory framework. As per the amended law, SEBI can regulate any money pooling scheme worth 100 crore rupees or more and attach the assets in cases of non-compliance. SEBI chairman is now authorized to order search and seizure operations. The market watchdog now has powers to access any information, including phone call records, regarding cases investigated by it. The ordinance allows setting up of special courts to speed up SEBI-related cases. SEBI is also fighting a protracted legal battle in the apex court to ensure refund of over 24,000 crore rupees to the depositors of Lucknow-based Sahara Group.
Subir, as a former regulator, is there a case for regulators always wanting more and more powers, never being satisfied with that? We'll come to the issue of ordinances later, but I just wanted to ask you, can regulators ever be satisfied?
Well, I think it's a balancing act because obviously institutions work on turf. You know, the more turf they have, the more scope they have, the more powers they have, the better they feel about themselves. So it's almost instinctive that a regulator which is supported by a legal framework is always looking to push the boundaries. You know, we know what to do, we know best what to do, and therefore, you know, give us the power to do it. But the flip side of that is the risk that when they have the power, they don't match it with the capacity to exercise that power. So you're looking at particular types of skills, you're looking at particular kinds of knowledge, you're looking at particular process design issues, all of which may be quite archaic. And I can say this with some sense of experience that many of our processes, not just in the regulatory framework in the government, are archaic in relation to the need to react to current situations. But that's where I think the dilemma comes in. That is, you give certain powers, and then the reason you give powers is because you believe that this is going to make things better for the ultimate beneficiary, which is the consumer, the average, the man on the street. But if those powers are not used correctly, if either they're inefficiently used or they're wrongly targeted, they're wrongly used, both of these cause some harm to that objective, they undermine that objective. So I think we have to look at power along with the capacity, the skills, the understanding to use them, and that brings the whole checks and balances, who is going to regulate the regulators kind of eternal debate. But the basic principle from a practical standpoint is if you're going to give powers, then you must ensure that it has the capacity, that the institution has the capacity to exercise those powers efficiently.
Okay, my last question really is that given the gap between the powers and the wherewithal to exercise those powers wisely, shouldn't this matter have been debated, at least in Parliament? Where was the rush to need to issue an ordinance? I
think there are three factors to consider here. One is the provocation. The provocation was clearly the Sharada episode, and this is impacting confidence across the board in financial institutions, because everybody is seen to have failed somewhere. The institution itself is accused of fraud, but there are people who should have been observing it, who should have been monitoring it, who obviously are now perceived to have been sleeping on the job, let their guard down, whatever. Whether correct or not is a separate issue, but that's the perception.
Right.
So I think the need to act quickly in response to this perception was important, and an ordinance typically is issued in a situation which requires immediate response.
Quick action,
and the merits are broadly, I think, accepted. The specifics of the power and so on, I think, need to be debated. But I think the need here will not be challenged. Then you get to the practical issue, which is that if you were to push it into parliamentary process, given the larger context of legislation now, what are the chances? When will that happen? So you've essentially bought yourself 6 months of time, and you hope that you'll be able to push it through during that time.
Yes, I think on that note we come to the end of this program. Thank you, Subir, so much for being with us. It's been great having you. But before we close, let me give you the key takeaways. I think as far as FDI is concerned, Subir made a very valid point. Though these are enabling provisions, but we need to make the environment as good for domestic investors as for foreign investors. As far as RBI's actions were concerned, Subir explained to us why the RBI needed to do what it had to do, and what the hope is always to reduce the volatility in the rupee so that people can be cushioned against those shocks. And last of all, in SEBI, he was quite emphatic that regulatory powers are all very well, but they need to be matched with the wherewithal to exercise those powers well. And with that, I think we come to the end of this program, but we'll be back next week, same time. So please stay with us.